Hi everyone, welcome back to the channel. I'm MJ from MJ Kane Accountants, and today I'm breaking down what we feel are the key tax and business announcements from today's UK budget. So before we get into it, it's important to say that a lot of these changes don't take effect straight away. Many of them will start in 2026, 27, 28, and even in 2029. So this is very much a budget that gives you time to plan. And I want to explain exactly who will be affected, what that impact will look like in terms of real money, and how you can protect yourself and your business if you plan ahead. Let's start with ISA changes because this one affects a lot of medium to high earning business owners. So right now your annual cash ISA limit is 20,000, but under the new rules that limit will be reduced to 12, and the remaining 8 will only be available if you invest in stocks and shares. So that means if you prefer to keep everything in a cash ISA, then the maximum allowance will fall. So who does this affect? Well, it's mainly people who save large amounts each year, such as company directors who take dividends and use ISAs as a tax-free wrapper. And the impact is simple. If your allowance goes down, more of your savings could become taxable, which means more of your interest and investment returns could be exposed to tax. One way to help yourself here is to review your savings mix. Even allocating a small portion of your allowance into stocks and shares ISAs will preserve the higher allowance. And it's worth reviewing this with an advisor to make sure that you're not losing valuable tax-free space. And what we'll do is we'll link below for one of our partner FIAs in the description. Another major change that affects almost everyone is income tax and national insurance thresholds are going to remain frozen until 2028. The personal allowance stays at 12,570 and the higher rate threshold will stay at 50,270. And that doesn't sound like a change, but it actually means that you're going to pay more tax every year as your income rises with inflation. And this is what we call fiscal drag. So even though the rates aren't changing, more and more of your income will be taxed at higher levels. You can protect yourself by planning carefully. For example, by increasing pension contributions, using salary and dividend combinations if you're a director, and making full use of all the allowances that are available to you. Now let's talk about the big change for business owners, the increase to dividend tax, property income tax and savings tax that we are assuming will start in April 2026, but it wasn't clear in the announcement. The basic rate for these types of tax is going to go up by 2% points. So for dividends, that means the basic rate will go from 8.75% up to 10.75%. Higher rates are going to go from 33.75% to 35.75%. And for additional rate taxpayers, property and savings income will also rise by an extra 2%. So who does that hit? Well, it'll affect almost every company director who pays themselves through dividends and every landlord with property income. The impact is that your personal tax bill will increase, even if your income stays exactly the same. So to help yourself, start planning ahead, consider pension contributions, changing how you extract your profits, or using ISAs where possible. It's unclear at this point if the increase in property tax will apply to companies with property income, but it's safe to assume it won't. And from our perspective, this change feels like a significant additional burden on small business owners and property investors, particularly at a time where we see so many of them already facing a lot of economic pressures. So while the government may view it as a way to raise revenue, we feel that it risks discouraging reinvestment into businesses and the property market, which contradicts their small business growth plans, which were announced today as well. Next, let's look at a positive change. The new 40% first year allowance for new businesses. Currently, many businesses will rely on AIA or annual investment allowance for full expensing, but those rules will vary depending on how established you are and what you purchase. So under the new rule, new businesses will be able to deduct 40% of the cost of qualifying assets straight away in their first year. And this is particularly helpful if you're a startup investing early in equipment, tools, computers, or machinery. So the impact is easy to understand, a lower corporation tax bill in year one and better cash flow. If you're starting up soon or planning early investment, make sure those assets qualify and consider bringing purchases forward to maximize this relief. This is unfortunately something we saw coming, but we hoped we were wrong because it's a big long-term change, and that's pensions and salary sacrifice. So right now, salary sacrifice is one of the most tax efficient ways to save into your pension because you'll save both tax and national insurance. However, under the new rules, starting in April 2029, only the first 2,000 of the salary sacrifice contributions will be exempt from national insurance. This affects directors, higher earners, and employers who offered enhanced schemes. The impact is that the tax advantage of a salary sacrifice will reduce. And the solution, well, it's to plan ahead, review your pension saving strategy, and consider alternative benefits if you currently rely heavily on the sacrifice. Now let's move on to corporation tax. This one's really simple, nothing's changed. The main rate will stay at 25%, small profit rate will stay at 19%. So if you were expecting a rise or hoping for a reduction, neither is happening, but stability is valuable. At least you can plan your tax position without any sudden surprises. VAT thresholds were also rumoured to be changing. Everyone thought that the registration limit was going to decrease to 30,000. Thankfully, the threshold has been frozen and will remain at the current rate of 90,000. Now, there are pros and cons to this, in my opinion, because even though the threshold hasn't been reduced, it has stayed the same. So a lot of business owners' turnover will be rising due to inflation, and more businesses will be pushed over the threshold and will be required to register for VAT earlier than expected. Now, what we would have loved to have seen is an effort to introduce reduced VAT rates into retail and hospitality businesses. It would have been a massive boost to sectors who primarily deal with the general public, where VAT isn't actually recoverable and so impacts more. If you're approaching the threshold, it's important to start planning your pricing and cash flow now so that you're not caught off guard. So next, the government has announced tougher action on tax avoidance schemes and increased powers for HMRC. This will not affect normal business owners who operate fairly, but it will affect people who have been tempted into so-called tax reduction products, especially schemes promising things like a 90% take-home pay or offshore loan arrangements. The new rules will give HMRC the authority to issue penalties, demand repayments, and intervene earlier. So the message is simple. If a scheme sounds too good to be true, it probably is. Stick to regulated advisors only. Let's talk about apprenticeships, because there's some good news here for small business employers. SMEs will now receive fully funded apprenticeships for anyone under the age of 25. That means if you take on a young apprentice, the government covers the training costs, which previously could have been several £1,000s and probably would have put you off. That is a great opportunity if you need to grow your team, reduce wage costs, or bring new skills in. Apprentices can be extremely cost effective now for expanding your workforce. So next, there are changes for people living abroad who pay the voluntary Class 2 national insurance to qualify for the UK state pension. Right now, many overseas workers can secure a full UK state pension by paying 10 qualifying years of contributions. Under the new rules, the number of years required will be increased, meaning you'll need more contributions to qualify for the full pension. Now, if you're a business owner planning to retire abroad or you spend long periods overseas, this does matter, because failing to make enough years contributions means that your pension will be reduced. The best thing you can do is check your national insurance record now, top it up while the current rates still apply. Student loan repayment thresholds are also staying the same. This affects employees and younger business owners. Because the threshold isn't rising, more people will begin repaying earlier, so monthly deductions may increase. There were also adjustments to property taxes in England aimed at increasing tax collected from certain property types. So if you own investment property or commercial properties through your business, you may see higher bills. This is the time to review your portfolio and check whether certain properties are still performing well after tax. So there were also changes to vehicle taxation, including new taxes for electric vehicles. Previously, EVs benefited from low road tax and lower company car tax rates, and under the new rules, electric vehicles will begin paying forms of road tax that didn't previously apply. So if you run a fleet, or if you're a director using an EV as a company car, factor these costs in going forward. So that's a full breakdown of everything tax related announced in today's budget, what the changes are, who they affect, and what the impact is, and how you can protect yourself financially going forward. If you'd like personalized advice, or if you want us to help you plan around these changes, get in touch with us or drop us a quick question below. Thank you for watching. Don't forget to subscribe, and I will see you at the next video.